I have been involved in the finance and investing industry for over 7 years now, and in this video, I plan to share with you 13 beginner investing mistakes and sometimes even experienced investors as well. My plan is to share these mistakes with you so that you can avoid these mistakes going forward, especially if you are a beginner investor and you may not know what to look out for. And by avoiding these mistakes, my goal is that you will increase the potential return of your investments over time. Let's get started. Stock market investing mistake number 1 is selling too early or selling at all. In my opinion, selling your investments too early is actually a big mistake, even though you are securing a profit, which is a good thing after all, because when you're investing in the stock market, the goal is to grow your money. But let me explain. As a stock market investor, particularly a long-term stock market investor, you have to have a long-term mindset. In the short term, there's going to be a lot of noise in the changes of the stocks that you are investing in, but if you are investing in a company and the stock price increases, typically that means that the company is doing very well and investors are receiving that news related to that company very, very well. And as a long-term stock market investor, if your company that you're investing in is doing very well right now and is exceeding the expectations of investors, how do you think that company is going to be doing 5 years down the line or 10 years down the line? More often than not, if your company is doing very well right now, in 5 to 10 years, if they continue to do the work that they're doing, you should see even further returns on that investment. So just because your investment increased by 10, 20, or 25%, it doesn't necessarily mean that you should sell that investment to secure your profits. Because in most cases, if you are investing in a quality company and that company starts to perform very well, 3 to 5 to 10 years down the line, chances are that company will have continued that positive performance and your investment will continue to grow with that company. Also, another benefit of holding your positions longer is that you will get into long-term capital gains, which means if you hold an investment for longer than 1 year, you will pay a lower tax percentage in most cases compared to your ordinary income tax rate. So by holding your investment longer, when you eventually do sell, you will pay less in taxes on the gains that you've made, which is another huge benefit of holding stocks for longer periods of time. Investing mistake number 2 is buying penny stocks, which I'll define as buying any stock with a value of less than $5 per share. While these penny stocks or low price stocks may seem extremely attractive because you can buy a significantly higher number of shares than you could afford when buying a more expensive stock, investors fall into the trap of thinking that since you can buy more shares of stock, you would be worth a fortune if that stock price actually does increase in the future. And because of that, they are attracted to lower price stocks, especially investors with smaller accounts, because since you can buy more shares, in theory or psychologically, you feel that there is a greater potential gain for you if the stock price explodes in the future. And while that is true, in most cases, a stock's price is very, very cheap because there's not a lot of demand for being invested into that company, because at the end of the day, stocks do represent part ownership in a company. While you can buy significantly more shares of a very low price stock as compared to buying a more expensive stock or company, it does not necessarily mean that buying more shares of a cheaper stock is better than buying fewer shares of a more expensive stock. Big investing mistake number 3 is shorting the market or betting against the market. I'm not going to explain it here, but shorting the market or shorting a stock is essentially betting against the increase in that stock's price. By shorting a stock, you actually profit when the share price falls, which means you are betting against the success of that company, or in some cases, you could actually short the entire US stock market by shorting shares of a stock market ETF like SPY, which is the S&P 500 ETF. If you short shares of SPY and the overall stock market declines in value, you will make money. And while it seems like an interesting idea and very favorable in some scenarios, it is incredibly dangerous to short stocks because you theoretically have unlimited loss potential and you are betting against the optimism that America loves to have. And as Warren Buffett said, never bet against America. I have a video explaining how shorting stocks works, which you can find in the description below if you're interested to see how it works. But as I said, it is a very dangerous strategy, and I would not recommend it as a long-term investment strategy to build your wealth. Big investing mistake number 4 is not considering your commissions and your fees. Fortunately, most major brokerage firms these days offer free stock trading, which means you can buy and sell shares of stock without paying any commissions. And this is a huge benefit for self-directed investors that are trying to buy shares of stock, particularly if you are only buying 1 or 2 shares of stock at a time, which is going to be most investors. But on the off chance that you are trading with a brokerage firm that might charge you $5 to buy a share of stock, if you buy 1 share of a $100 stock and you pay a $5 fee for that trade, now you need the stock price to increase 5% to $105 just to get your commission or your fee back from entering that position. And obviously, that is going to be a huge drag on your returns over time, and particularly if you are buying only a few shares at a time. So if you are not with a major brokerage firm that has free stock trading, I would highly recommend considering switching to one because, as I said, if you are only buying a few shares of stock at a time, which is going to be most people, then having free stock trading is absolutely critical. Big investing mistake number 5 is being too active in the markets. While the increase in investing technology is a phenomenal thing for investors, as we can use better software to access the financial markets and invest in things, it is also a dangerous thing because, especially with things like an app on our phone where we can log in and see the performance of our investments on a daily basis and also make trades based on what we're seeing, it can be very easy to make emotional decisions with the ease of accessing the financial markets. So being too active, in my book, means that you are buying and selling around a certain stock price movement and you're not actually investing for the long term. So while the investing technology is very, very good for us because we can access the financial markets virtually for free without paying any commissions or fees, it is also a very dangerous thing because it makes it very easy to make investment-related decisions, and for the most part, you are not going to want to be too active, especially as a long-term stock market investor. Another benefit of not being active in the stock market is that you will keep your taxes much more simple compared to if you are buying and selling stocks every single day and trying to time the short-term movements in the stock market. Investing mistake number 6 is taking excessive risks with a small portfolio. So when you're just getting started with investing, typically you're going to have only a few $100s or a few $1,000s, and because of that, you might feel encouraged to take excessive risks to grow your account faster than you would otherwise. So for example, if you invest $1,000 into a stock, you might be thinking, well, if this stock price doubles, I'm only going to make $1,000, and that just doesn't seem attractive enough for me. So because of that, you might be encouraged to buy 500 shares of a very low price stock, and therefore, because you own 500 shares, if the stock price only goes up a few dollars, you could make thousands of dollars. But as I mentioned earlier, investing in these low price stocks and taking more risks with the potential huge reward is not necessarily a long-term investment strategy that has a high probability of building your wealth over time. The best way to get out of small account territory is to invest the little money that you have in quality investments and save as much money as you can over time. That is the best way to get your small account into a large account, as opposed to taking excessive risks by using exotic financial instruments or investing in penny stocks. Investing mistake number 7 is not having enough diversification. An example of not having enough diversification would be putting 100% of your investment portfolio into a single company's stock. And the reason that would be risky is because you are betting 100% of your investment portfolio and your future investment savings on one company's success. And if anything goes wrong with that one company and something happens that you did not expect, then there goes your entire investment portfolio. So very recently, I had $3,000 invested in a company called Luckin Coffee, and unfortunately, while everything I read online seemed very favorable, it came out very unexpectedly that the company was actually fraudulent and they were faking their earnings numbers. and overnight the stock price fell 90%, and it has been halted ever since, which basically means I lost 100%. So it was lucky that it was only $3,000 and not 100% of everything that I had, because if I, for some reason, wanted to bet it all on this one company and overnight I lost 90% of it, well, now I have to restart from zero. So it's a great idea to research multiple companies to invest in, to start a portfolio of different companies that you're investing in, and that way you will protect yourself from a catastrophic investment loss, as you would experience if you invested everything into a single company and that company went belly up. And a great way to get extreme diversification with a portion of your portfolio is to invest a percentage of your portfolio into a broad stock market index ETF, such as SPY, which is the S&P 500 large cap index, or something like IJH, which is the S&P mid cap index. I actually made a video of the top performing stock market index ETFs for the last 20 years, and you can find that video in the description below. Investing mistake number 8 is being too risk averse. Now, this might seem funny to you because the last thing I just said was we have to be diversified, but there is a happy medium between having an aggressive risk tolerance, such as putting 100% of your investment into one company stock, and the opposite, which is not taking any risks at all. So I think as a young investor or an investor with over 10 years before you actually need to use your investment money, I think it is a good thing to research individual companies that excite you and that have products or services that you think are beneficial to the world or even could be more prevalent in the future, and investing in some companies within those industries. But as I said, with a small portion of your portfolio, I think it is a good idea to invest in a broad stock market index ETF, such as the S&P 500 or the Dow Jones Industrial Average. So there's a happy medium between putting 100% of your investments into one stock and the complete opposite, which might be you don't even want to invest in the stock market because it's too volatile. As I think both of those approaches, especially if you have 10 plus years before you need your investment money, I think both approaches are a mistake. Investing mistake number 9 is selling in a downturn. This is perhaps one of the worst things you can do as a long-term stock market investor, because it can be very easy as a human to see the value of your investments declining and you want to sell everything and get into cash because you can't stand seeing any more losses in your investments. But as I said, if you are a long-term stock market investor, using downturns is actually a phenomenal buying opportunity because, first of all, you can buy a higher quantity of shares with the same amount of money as compared to before when the stock prices were higher. And also, because you can do that, you will aggressively reduce the cost basis or the effective cost per share of your investments. So using downturns as a buying opportunity as a long-term stock market investor is a phenomenal strategy. But on the other hand, selling your investments during a downturn is a horrible strategy because, historically speaking, stock market downturns recover with time. So if you were an investor in 2008, 2009, and you sold your investments during the decline, unfortunately, you had to watch the stock market recover 5 times since then, since the S&P 500 reached a low of about 600, and currently today it's around 3,000. Even including a portion of the market crash that we just saw in March of 2020. So my advice, or what I plan to do, is to use downturns in the stock market to buy even more shares of companies that you love and reduce the effective cost of those investments. Investing mistake number 10 is investing in complex or exotic investment products that you do not fully understand. In the world of ETFs, or exchange traded funds, there are very straightforward investment products, as the one I've mentioned called SPY, which represents a broad investment in 500 companies across all sectors of the US economy. But then there are more exotic products, such as a 3x leveraged S&P 500 fund, which actually aims to return 3 times the percentage return of the S&P 500 on a daily basis. And that may sound great and exciting, but these products, more often than not, are meant for very short-term trades, and they are not meant for long-term investments. So I would say If you are investing in the stock market, make sure you stick to very straightforward investment products such as broad stock market ETFs or individual companies, and I would avoid anything that sounds exotic or anything with inverse, leveraged, or 2x or 3x in the name. Those are going to be your more exotic instruments that I would avoid, because if you do not understand what you are investing in, most likely you are going to lose money and you are not going to know why. Investing mistake number 11 is forgetting about the company behind the stock. So always remember that when you are buying stocks, you are investing in a company, and because of that, it's important to be involved or somewhat involved in how that company is performing, because if the company is performing well, so will the stock price. But on the other hand, if the company starts performing not so well, or it turns out that the company is a fraud, then the stock price will crumble. Investing mistake number 12 is not continuing to learn about the financial markets or the companies that you are investing in. It's okay if you don't want to be super involved and you don't want to research individual companies and you just want to invest in the stock market or a conservative index ETF and earn the market return every year. That's completely fine. But still, it is good to learn enough to get to that point. But if you want to be more invested in your finances and you want to be more involved, I think it's a phenomenal thing to continue learning about how the financial markets work, different financial instruments that are available to you, as well as the companies that you are investing in. Personally, I like to have a more involved approach to investing, not necessarily meaning I'm buying and selling a lot, but involved meaning I am researching the companies that I am invested in, I am staying on top of the news, and I am always learning about more financial products, because one day I might need to use those financial products or want to use those financial products, and knowledge is power. You don't necessarily have to use the knowledge right now, but simply having it will leave you very prepared if you do happen to need it in the future. And finally, investing mistake number 13 is leaving it entirely to professionals. As I just said, you don't have to be super involved in the stock market or your investments, but at a bare minimum, I think everyone should open up their own brokerage account and learn how to buy a stock or buy a broad stock market index ETF, such as SPY or the S&P Midcap, which is IJH. And I think that because you can invest in the market and earn the market return every single year and pay virtually 0% in fees. But if you decide that it's too much for you and you want to instead pay a professional to invest in mutual funds for you, then more often than not, you are going to pay significantly higher fees. And over a long period of time, those higher fees are going to seriously eat into the long-term return potential of your investments. So at a bare minimum, if you don't want to be super involved in the markets and actually invest in individual companies and learn about the individual companies, at a bare minimum, I think everybody should learn enough to open up their own brokerage account and be able to put money into that brokerage account every month and purchase a broad stock market index ETF such as SPY. Or you can use something like Wealthfront, which you can set up a recurring deposit and they will invest in these low-cost ETFs for you. Even in that scenario, you'll pay a little bit higher in fees, but at the end of the day, in most cases, it will be cheaper than investing in a mutual fund, especially if you have a financial advisor that is investing your money for you. I have a video that I just made called How to Buy a Stock, and in that video, I actually walk through the process of opening a brokerage account so you can see exactly how quickly you can open a brokerage account and fund it. And then I also show you exactly what it looks like to purchase a share of stock on your own so that the whole process doesn't seem so scary to you. So if you're interested in seeing that video, please look at the link down in the description. That's going to do it for this video, everybody. I really hope you learned something and that some of these mistakes were not so obvious to you. I didn't want to go with the super obvious mistakes. I wanted to kind of use my experience in the markets to share the things that I have done wrong so that I can help you boost your investment returns in the future. If you enjoyed this video and you want more content like this, I would love to have you as a subscriber. So if you'd like to subscribe, be sure to hit the subscribe button down below and enable notifications so that you can get all of my videos in the future. And if you have any questions related to this video or you want to add something that you've learned from your own experience, please leave a comment down below, as I would love to hear from you. My name is Chris Butler, and I will see you in the next video.